Hi, Michael.
Hi, Emily.
What are you wearing today, Michael?
I'm wearing the Broncos Indigenous jersey in honour of the fact that the Broncos are playing the preliminary final on Saturday night against the Warriors, and hopefully they'll win that game. And then I'll continue wearing it the next week because that'll be the grand final. And if they win the grand final, I'm going to wear it a lot the next year.
Well, when this podcast episode drops, everyone will know what's happened with that. Before we introduce our podcast guests, though, I'd just like to acknowledge the traditional owners on the land on which we've recorded our podcast episode, the Turrbal and Yagara people, and pay our respects to the elders, both past, present, and emerging. In this podcast episode, we spoke to Michael Kearney, and he's a director at Denning Investment Partners. Denning Investment Partners are non-bank financiers in the construction industry. And before I sat down with Mike and had this chat, I really wasn't aware of the role, how important the role and what role non-bank lenders played in the industry. And I just learnt so much from chatting to him.
Yeah, he was very easy to talk to. He's very knowledgeable. He comes from a banking background and stepped into the non-banking area. He's definitely a growth thing that's happening in the industry in terms of providing different forms of finance as opposed to the banking finance. So, he's a very interesting bloke.
It was an awesome episode, so we hope that you enjoy. Okay. Hello, Mike. Welcome to the podcast.
Good morning. Thank you for having me.
Oh, thank you for joining us. So, Mike, you're a director at Denning Investment Partners. We'll have done a little intro beforehand. Do you want to jump straight into your background? Who is Mike and what do you do?
Absolutely, let's do it. So very briefly, I'm a property finance professional. I've worked at the major banks for the entirety of my life, starting in Brisbane at the major top four banks, always doing investment finance, construction finance, popped over to London for a good couple of years and moved into the non-bank space. I've subsequently come back to Australia and again, staying in the non-bank stratosphere with Denning Investment Partners. So it's certainly an emerging sector in Australia at the moment.
And Denning Investment Partners, so it is a non-bank lender for particularly in the construction space. What does that mean?
That's correct. So the banks versus the non-banks is probably some terminology that you're hearing more and more. So I think we might deconstruct that today. The banks are getting more and more heavily regulated. They need to be unquestionably strong is what APRA is the terminology APRA uses. So we can't have them defaulting. That you've got mum and dad investors. It's a big, especially the top four banks in Australia. They're the cornerstone of our financial system. And as we know, construction finance can have its risks. And the banks are lowering their leverage ratios. They may be increasing their pre-sale requirements. They may be increasing their interest coverage ratios for investment assets. And so slowly, that just gets harder and harder sometimes for developers to actually procure finance from the banks. So this has resulted in the non-banks growing significantly over the last 5 to 10 years. The Europe and US markets are significantly more advanced than the Australian market is. But you've got a number of non-bank financiers now in Australia, which I'm sure you've heard a number of them. Denning is one of the more boutique houses. We've got about a bill and a half of assets under management, and we like that size. It's a good, nimble size. We've got a team of 10 across Australia and New Zealand, and we actively manage our loans. So we can push the LVRs on projects. So say a bank on a residential construction project might be at 65% LVR, and that's loan to value ratio. We might push it to 70 or even sometimes 75% LVR if the project makes sense. And again, it's good sponsors, good projects, good people that we like to work with. So we do have flexibility around the credit framework, but nonetheless, our underwriting and our credit approval and investment processes are very rigorous, and we do analyse the transaction, not too dissimilar to the banks, just more flexible on the covenants there.
And would you say from that, at Denning, you have a bigger risk appetite for lending?
Compared to the banks, yes, but also because the banks used to actually be not too dissimilar to where we were. I can remember back prior to the global financial crisis in 2008 and prior, the banks were doing, 65, 70, even some mezzanine pieces, I recall. So we've just filled in the gap where the banks used to be. So yes, you could say it's a higher risk appetite that Denning has, as well as the other non-bank lenders have. But also we're filling the gap that's been left by the banks as their thresholds have reduced and as they've become more conservative.
Yeah. Okay. So would you, on a project, do you typically lend as a second lender where the bank's already funding a project, or are you the main lender, or is it a bit of both?
Primarily, we are first lender of record, first mortgagee, and that gives us quite an amount of control, just like a bank does. So we do prefer a first mortgage position. If there has been some instance where it just absolutely made complete sense, where we did provide some top-up mezzanine funding, and we have done that. We've got an AFSL, and we procured that under our own steam. We do like having control of the project as a first mortgagee lender. It gives you a lot more ability to structure the transaction, and especially when things go wrong, like we've seen in this market at the present time, where we've got, unfortunately, far too many builders falling over, it does give us the flexibility to really get in there and make sure we can have a very strong oversight of that process.
What kind of projects do you typically fund?
A lot of residential at the moment, anything typically $10 million debt size and above. Our largest project's 175 New Zealand dollars at the moment, over in New Zealand, of course. And at the present time, we've got a project significantly larger than that we're analysing in Australia. Residential really is the substantive part of any loan book. We absolutely are interested in commercial, mixed-use, industrial. Commercial at the moment obviously has its nuances with cap rates coming down and just the occupancy rates of commercial offices. Residential is ticking along very nicely in the Australian economy right now.
So when you're talking about residential, you're talking about high-rise residential essentially, or mixed sort of approval?
Yeah, absolutely. So high-rise, mid-rise, townhouses, land subdivisions, all of the above. And we do in Globo land. Land subdivisions we really enjoy. It's our forte. I've done a lot of it with the banks, and now moving into the non-bank sector. I've done a lot of land subdivision financing over the years and understand it very well.
When you say, did you say in Globo?
In Globo, yes.
What does that mean?
So large scale.
Good pickup.
Good question. Large scale land development. So you might have 1,000 lots that's to be developed, and you might each stage might be, say, 50 to 60 lots per stage. So we would provide a construction finance facility for stage 1 and a balanced land facility for stages 2 to 10, which would be progressing and at various stages through their approval process. So you need to have an understanding of the different risk profiles of your lots under construction versus your balanced land.
How do you actually fund these projects?
In terms of our capital?
Yeah.
So we partner with a number of institutions across the globe. We actually used to be known by the name Denning Asia, because we actually received substantial amount of capital out of Hong Kong and Singapore, given that's quite cost-effective capital. We've diversified our sources through to the US, Australia, and always looking and procuring new capital sources. So it is a combination of institutional capital, but again, we do have our AFSL, and we do capital raise with high net worth individuals around Australia.
What was that IS?
The AFSL.
Meaning?
Australian Financial Services Licence, which means we're approved to run wholesale investments. If we don't have that, we're getting quite a bit of trouble with the law.
Before I kind of ask some more meaty questions, what's your most favourite thing about your role? What do you get passionate about your job?
Getting on site.
Yeah.
And speaking to the borrower, the builder, and getting to know the whole process and seeing if, for example, if it's a residential apartment project, walking on the site and seeing it as a block of land, seeing the basement get excavated, you see the process and the complexities in the basement construction, and then slowly but surely the superstructure coming out of the ground, and getting to walk it and see it from a concrete pad to then actually seeing it framed, fitted out, and then the kitchens and the bathrooms and it all coming together. And then in 10 years' time, driving past it and still being proud of that project. We like to be proud of our projects. Nothing worse than seeing some developments that get delivered in the market that maybe not hit the mark.
It's funny, without taking the spotlight away from the actual contractors and like developers behind the project, it's funny you don't think about the lenders and the lawyers and all those who've also seen those projects through, or
That's correct, and you would appreciate this from a legal perspective. You're often not thought of in the relationship there, but legal absolutely a very critical component of it, and the financing. Obviously, without financing, there'd be very few projects getting off the ground.
The hidden heroes.
the heroes. So at what kind of point in the project do you generally step in? Would you come in from the beginning? Do you ever come in when work's already commenced?
Best case scenario is a financier comes in at the start of a project, and so that might be with the land that has its development approval, DA, with DA, without DA. So with the development approval means it's gone through the planning consent process of the relevant authorities. And on times occasion, we might lend on the land without development approval. If it's in New South Wales development consents, all planning permits is all slightly different terminology across the country, but they all effectively mean the same thing. We then commence construction and would provide construction financing throughout the project with our loan. It might be quite a big loan, 20, 30, 40, 50 plus $1 million out the door. We don't necessarily on a residential project get repaid that all in one instance. We get repaid from the 60, 70, 80 odd apartments or land lots that progressively complete with your mum and dad purchases per se settling that. On some rare instances, we might come in mid-project, especially if there's some delays or there's been some builder issues. We have seen several of those recently where a project may have been with one of the major banks. There's been a few issues in terms of the build with supply issues and costs going up significantly as we've well seen. And we may come into a project mid-build. It is a lot more complex because there's a lot of work that you need to understand what's been done and make sure that it's been done correctly. It can be done. It wouldn't be probably most lenders' first preference to come in mid-build.
The capacity for you guys to lend more than the banks, say up to 75% of value, that must be an attractive option for developers in this uncertain market when they're trying to understand the true price, the costs of the build. You know what I mean? So there's almost a bit of a buffer there for builders to incur greater costs out of their control in terms of supplies, and therefore give the developers an opportunity to sit down and negotiate, a compromise which allows something for the builder to recognise those increasing costs, but also get the project done, and you've got the finance locked in. Am I?
Yeah, I think you're touching on 2 points there potentially. So yes, we advance more capital so the developer has less equity in the project. So that means they could maybe take on 2+ projects where with the banks it might limit them to 1. So it gives the developer more equity. The second part of the question I believe you're touching on, Michael, is the rigidity of banks and working through construction contracts. So as you may well have heard in the media recently, fixed price, fixed time contracts.
Yep.
And the issue has been there, a builder will come in, agree the price and agree the time, and banks require that very strictly. And what's happened is the costs have gone up. So it's been impossible for the builder to pass those costs back on to the developer. And so the builder gets into a position where they might have quoted for a job at 20 million. Their inputted costs are now 22 million, and they can't pass that on. So really good question. There are abilities for, especially Denning has done this actively on a recent project where we have allowed a higher degree of provisional cost items. So where it's a fixed price contract, it is fixed for most of the items, but there are certain items that are detailed in the schedule, and we get our lawyers to very articulately word that for us, that we allow some rise and fall for some provisional cost items. And we've assessed that in terms of the overall budget, and we have allowed that flexibility in those contracts. Linking back to a podcast that you had with Jack Hutchison just a couple of weeks ago, that was exactly one of the issues that he pointed on, and needing more flexibility for the builders in the build contracts, and that's definitely something that we can entertain. We see a builder completing the project is more important at the present time than locking in that fixed price, fixed time component, because we know it costs a lot more should a builder not finish the project like we've seen.
That's exactly what I was trying to say, but you said, you said so much better. It's like that buffer, you know, there's a buffer in there that allows the developer, because they know that they've got a little bit more money in the kit, to be able to sit down and sensibly negotiate and get a deal done with the builder, to give them a little bit more, to recognise the escalating costs with the objective of getting the job done.
Correct. And it's not about giving the builder more money when they haven't rightly incurred it. With some of these major projects, you see these 4 or 5 year projects, they don't actually lock in, and they can't lock in some of the major items 12, 24 months after they've actually signed that head contract. So what it gives them the ability is to ride the market flexes there. And so that's, you know, and we would rely on our professional consultants, the QSs, quantity surveyors, and the borrower, of course, the developer, would check through those items and make sure that it's an appropriate cost schedule there before that variation to the contract's achieved. Correct.
If I take it back a step, just to understand how those, are you like giving your finance to the developer once you're happy with their contract with the head contractor, or how those terms, where do you fit in the negotiation of those contract terms?
Really good question. It's evolved. So back 10, 15 years ago, it would have been the developer agrees a build contract and brings it to the bank or the non-bank financier and says, here's our package, get it approved, let's go. And it was always the financier doing the due diligence on the builder and making sure that the builder was acceptable. With the rise of the non-bank lenders, the builders are turning around and going, well, hang on, we want to not only know who the developer is that they can pay, but who's your financier behind it. So there's a lot of builders doing due diligence back up the line to make sure that they can get paid and protecting themselves from the developer default or a financier not paying. It's a really, really significant issue. And so with the variations in the build contract that we're seeing, financiers are getting into the room earlier. And when the construction contract is maybe in towards 80, 90% agreed, the financiers may come into the room and assist with that. We walk an important line where we're not the directors of the developer. So we don't ever want to tell a developer how to do their job. But again, we can give them guidance on what would be acceptable and what would be financeable to us. So yes, we do have input, and we have had greater and greater input on that to make sure it works from a developer perspective, but also from a financier perspective.
And on the flip side, would you be telling them what would not be acceptable to you and that where you would draw the line?
Correct. So a cost plus contract in its purest form, which means a builder says, whatever it costs, and I'll put my margin on top and we'll deliver it for you. That typically won't work for a financier because the developer doesn't know what it's going to cost, and then the financier doesn't know how much we're going to loan. And so we can't, because we're achieving a modest return for a modest risk profile. The developer's achieving an equity return, but for an equity risk profile. So we need to have certainty and some framework around what the price and time of this contract's going to be, with certain tolerances within that.
Okay, that makes sense.
It has evolved, as I said.
And when we come back to risk, and how do you see the industry transferring risk back up? Because for a while now, and at FCon and in our chat with Jack, and in all of the articles that are coming out and talking about having fairer contracts and maybe making sure that risk is managed and placed on the most appropriate party able to manage that risk. How do you see that might need to change, or is it appropriate now, or what are your thoughts?
It's always been the case the risk should be applied on the party best able to manage it. Mm-hmm. The complexity is what we've seen over the past 24 months has been, I hate using the word unprecedented, but it nearly is. We haven't seen a 30-40% cost increase in such a finite period of time for as long as my professional history. Michael, I'm looking at you there.
Yeah, it's unprecedented, and it's in a way it is exactly what the industry needed, except for we've got to be conscious of saying that there have been real victims in this unprecedented sort of development. So I'm really conscious of the humans that are involved in this sort of stuff. But it's almost what the industry needs to be confronted with, to adopt and recognise there's got to be a change, there's got to be more collaboration, there's got to be more give and take.
I think that's going to be seen in due course, and banks will be coming to the party. The non-bank lenders are probably already there in terms of its flexibility. It's the banks that may have more difficulty because they've got the APRA regulation on top of them, their regulatory authority, that may constrict their ability to be more flexible in that regard.
Yeah. It's like I said, it's challenging times, but I don't know, to me it's almost like the industry needs to be almost taken to the cliff sometimes to embrace the need for change. I wish it wasn't that way.
It's certainly there right now.
But it's, and we shouldn't lose sight of the opportunity, and we shouldn't lose this opportunity to really make some meaningful changes and lock in some changes, because my greatest concern is that once the good days return, the old bad habits will come back again. All of a sudden we're just going to be back to where we were 5 years ago.
You're 100% correct, and we've seen some great builders and some great parties in this industry that are not here with us in their corporate context today, which is quite unfortunate, because Queensland particularly has a massive undersupply of good mid-tier builders at the present time.
Yeah, and my greatest concern surrounding that is mid-tier builders are so important to regional economies. You can get away with maybe just the top-tier builders competing in Brisbane or the Gold Coast or the Sunshine Coast, but regional economic development is so, pivotal based on what I call, category 2s and 3 builders that are locally, tend to be locally, created, evolved, and that it's just so important that we don't lose them in this sort of washout of change.
And not to get too off path, but we're seeing just the absolutely incredibly tight vacancy rates of sub 1% across all of Australia at the moment. We're seeing construction costs continuing to escalate, labour, and then you're also seeing just the delivery of housing continue to slide. And so with the net increase in Australian population, it's going to get more and more difficult for mum and dads and individuals and everyone to find a suitable place to reside, which it's scary at the moment. So we do need that underpinning property construction sector, sometimes thought of as, the big bad developer, actually delivering a really critical need for the Australian economy and the global economy.
I think it's important, and Michael is the biggest preacher of this, though, is you have to have respect for each other's difficulties and see the challenges faced by each party. Even when we were talking to Jack, he said developers have their own issues too, and it's important to have a conversation with respect.
And banks have issues. There's no point in bank bashing. You've got to understand that they're regulated through APRA, like you said. So it's like, let's just try to understand everybody's particular challenges in the context of how do we make the industry better. And to me, it's just been too easy to bash developers, bash banks, subbies bash builders. It's almost just like it's a game. It's been a game. And it's created this horrible sort of, adversary type of industry, which is just so counterproductive to good outcomes. Then you get these consequences of an industry which has got massive low productivity gains. Well, you're not going to get productivity gains unless you're prepared to work with everybody involved.
It comes back to our core ethos as a business: good people and good projects. And it is critically in that order. You have to have the good people first. You could have the best project in the world, but if the people aren't up to scratch, you probably don't want to be getting into it. We want to support that ethos. Absolutely there, Michael. Couldn't agree more.
So in the event that a project that you're funding does fall over, a contractor on a project that you're funding goes into administration or liquidation, or they're in significant financial distress, what is your action plan at Denning, or what rights do you have to kind of step in and take a
Great question. I laugh. Unfortunately, I think every bank and non-bank lender has had experience with this over the past 24 months. And this is where the expertise of the team and the financier are really, really, really important. As I said at the start of the podcast, I've been in property investment and construction finance my entire professional career. So it's super important to be working with parties that are understanding the complexities there. I think that's first and foremost. Choose your relationships wisely. Secondly, the financier should be on top of the project, so attending PCGs, and we're very active in that regard. So we can spot financial strain somewhat out. Projects typically start to slow down. You might be losing some of your key individuals on site, for example. When push does come to shove and the builder may not be able to complete that contract, there are several alternatives available to both the developer and the financier. The developer, if they're well heeled and well capitalised, can inject equity into that project to continue it on with a third party builder. We have also seen individuals with the expertise actually undertake the build themselves, and we've seen that across the market at the moment, where there are developers that have actually got a building license sitting there that's not actively in use, and they have activated that to complete projects. We've had one project sort of 18 months ago where that was the case. They presented to us a really capable team around it, and they were able to well and truly progress and finish off that project. It can get more complex than that. In terms of what rights a financier has, we obviously in that instance have to approve any incoming builder, whether it be a self-build or a third-party builder. So we need to be actively engaged in that process, and it can be a complex negotiation. And there's lots of interested parties in that as well. We, as a financier, need to protect our capital. That's obviously very important, but also we appreciate the absolute need to finish the project off, and it really comes down to balancing those sensitivities. In this market, we are very lucky that the gross realization of the product has also gone up. So if the developer has been able to cover cost overruns because you've seen 30-40% cost increases in the build, you've also seen 20-25+% increases on the end product values, which helps take away some of the pain. Definitely doesn't take away it all, but helps take away some of the pain.
I have two side questions out of that. What kind of due diligence do you do in internal processes that you think are critical, and how do you monitor those kind of red flags, or make sure that the project is going along well, so that you can maybe intervene or make sure that if there anything that might be a bit wobbly is okay.
Due diligence on the builder or due diligence on the entire?
Just generally, I guess.
Okay. Because I'm an ex-banker, and I think, a lot of my colleagues in other non-bank financiers, or a lot of them are ex-bankers, the framework and the due diligence that the non-bank lenders do is actually not quite the same as the banks. And that's great to hear, because it means you've actually got quite a robust non-bank lending industry in Australia, which is really important, because sometimes it can be tainted to say, they shadow banking, or they're off the cowboys. Actually, you've got some really, really capable individuals in that non-banking world. So we assess the capabilities of the developer, assess the capabilities of the borrower, and look at the project is the fundamental premise of what we look at. We are supported with evaluation from a top-tier valuer, same with a QS, quantity surveyors report, to analyse the cost of the project. We do our financial due diligence. Linking through on the builders, we would be requesting their work in progress schedule, so a list of their projects that they've got under construction, and seeing where they're up to in terms of progress and where they're up to in terms of their forecast cost versus their actual cost. And that sometimes in the past has been quite tricky to get, because builders want to keep their financial information confidential and don't want to disclose how much they're earning on certain projects, which we fully respect. But at the moment, actually, all the builders have been great, because they appreciate the complexities in the industry. And if they want to get this project financed, they now appreciate they need to disclose that information.
I think that's pretty similar. We have Helix compliance, and David, who comes from a finance background, he runs due diligence checks on could be anyone, contractor, developer, for our client entering the contract. And he does, we'll do a bespoke questionnaire and do up a report. And I think that it's fair to say that all of the answers and information that he requests from the other party to do his report and give a recommendation have been quite open, because they want to work together collaboratively and get on board and be able to do the project.
Correct. And we're seeing that more and more now, with third-party reports being done on the builder financials specifically. Yes.
It's something which has changed over the last few years. One of the good changes is that people do have to be transparent. And that does, having to, in a confidential sort of way, in a protected way, the information has to be provided to people who are casting their eyes over either the developer or the builder, or even major subcontractors, to be able to do what the contract requires them to do. So that does require a bit of opening up of your books, and there's no getting around it. David's experience has been the questionnaire is, I think he's been amazed that the information has come back, and he's obviously reconfirmed some of the information, circled back around, and it's been pretty accurate and it's been pretty good. So I think that's an indication how the industry recognises that, you just can't get in these silos and operate as if it was always the old way of operating.
And one of the key things that we've seen and we've continued to see in this market, it's often not your project that is the card that brings the house of cards down. It's the developer's other project, or it's a builder's other project that gets into significant financial distress, which has been the impetus for that issue. our projects themselves have actually been progressing quite well, and the one or two issues that we've had wasn't our project, unfortunately. And we've really moved hard to do a lot of things to make sure that it wasn't our project. Simple things like fortnightly builder progress claims. Of course, you don't always want to do that on every project because the administration increases significantly on that, doubles it effectively. But for the bigger projects where there's big amounts of money being paid out to subbies weekly, fortnightly, it can greatly assist in the builder's cash flow. And as we know, cash is king to actually remain financially viable. And actually in this market where labour is so tight and subbies are so difficult to get on board, offering them fortnightly payment terms versus monthly payment terms can actually be the trigger between them accepting the project down the road or your project. So it may not even be a question of financial viability. It's just what makes operational sense for the whole vertical integrated stream.
So so back to the point. So if you're taking on a client for a particular project, it's a really good point you made. Do you ask them to share with, and they've got other projects on the go, do you cast your eye over how those other projects are going? Because it's the potential, like you said, is that one of those projects could be the ones that crashes the whole thing down. So you do, and they're open to providing you that type of...
Correct. And we do that for both the developer and the builder. Yes. Mm-hmm. Yes. And if the builder's quite a large builder, it gets obviously more and more difficult to really analyse that. But again, the bigger the builder is, the more robust the financial reporting and cash flow forecasting might be. So you may not need to go down to that project level, but absolutely you are analysing the businesses and the stakeholders as a whole. And it comes down to the key personnel on the project as well, knowing that the people on your job have the skills and expertise to deliver the product that you're financing. So we always get a list of key personnel on our job from the builder.
That's one of the things that I always found is that, the A team might be over on this project and you might be funding, or this project might have, in fact, the C team, which has got significant issues associated with it in terms of, who the subcontractors are, who the specialists are, who the consultants are. And it's the capacity for the builder to bring, a broad spread of really experienced people across all their projects, not just the favoured ones, if I'm making sense.
Correct. And that comes down to the key personnel and the checklists and the reviews and due diligence that we undertake.
I guess to kind of wrap up our episode, are there is there a key lesson learned or any lessons learned that you would share over the past, maybe 12 months, 24 months, or even your entire professional career?
Deep question. I was... Again, I call it maybe fortunate, but it might not be the right word, to having worked through the global financial crisis and having seen the complexities there. So, a relatively new financier or growing financier, I learned a lot of lessons out of that. Vigilance is key. Remaining close to the projects is key. The relationships with your borrower, but not just your borrower, your builder. And it's not just the owner of the build company, but it's your project manager, your site manager walking the site. If you're not turning up to your PCGs as a financier and maintaining a very close connection with the borrower, the builder, and all parties involved, you may miss things. And I think finally, plan for the worst and hope for the best. It's so true. We do our sensitivity analysis, and the scope of those sensitivity analysis has been increasing over the past 12, 24 months, focusing on builder distress, but also as the gross realisations, I think it's fair to say, are coming to the precipice of that significant ramp up of where they've been, focusing on just where the sensitivities are in the project overall. But it comes with decades and decades of experience, really, and really knowing construction finance and property finance inside and out.
Yep. Good. Well, thank you for joining us, Mike. I've definitely learned a lot from chatting with you, and it's not something that I'd ever really gone into super detail with. I knew that non-bank lenders existed, but I didn't know the operations and how your role really works. So, yeah, I'm sure it'll make a great episode.
Yeah, thanks very much.
I appreciate you having me on.
Been really revealing.
Appreciate it. Thank you so much. Thank you.
I hope you enjoyed the podcast today. The information we discussed today was just that, information only. It is not specific advice. If you take action following something you heard today, it is important to make sure you get professional advice about your unique situation before you proceed, whether that advice be legal, financial, accounting, medical or other advice. Please reach out to the Helix team if you have any questions or if there's another topic you'd like to explore. And if you know someone who might benefit from the show, remember to tell them about it or point them to our Instagram, Facebook or LinkedIn.